Hi guys, welcome back. Back here with David here in London, working through the risk videos for you. Hope all's well, hope things are going well in your studies there. So we're up to the last of our 4 risk videos, and this is the shortest of the 4, and we're really kind of mopping up and bringing it all together as far as our summary of our risk area. I would say the middle 2, guys, the VAR-based recording number 2, and the third one around about the credit risk area, probably more technical, certainly more technical. This one here, more bringing it all together really. Remember, risk can be particularly wordy as well as a calculation, so important to read around risk, as we know it reflects the important function of risk all around us, of course. We started off drawing this kind of a relationship between return and risk, and introducing some constraints like capital and costs. Now, the way I look at this chapter in a way is starting to factor in the big picture of risk. Guys, earlier in your studies, you've looked at the IPS, your investor policy statements, and you've looked at someone's portfolio really pretty much as the main focus. The focus here is much more firm-wide. Remember, we talked about firm-wide approaches with enterprise-wide risk management. So that's the way to think about this. When we are looking at any of the risks that a firm's taking, we've talked quite a bit, for example, about appetite. Making sure it fits within the appetite. This chapter here is thinking a lot about how we take that appetite and spread the risk budget really throughout the organisation. For example, you might define risk in a firm-wide VAR. Maybe you have a VAR for the whole firm, and that starts to be allocated in certain departments, desks, areas, departments, market risk, credit risk, and each desk or head will have a budget, guys, that you're working towards in this way. At the same time, you're making sure, guys, to work within an appetite. Often talk about risk tolerance. What levels of volatility are you allowing around that kind of definition of appetite as well? Also in this chapter coming up, guys, we're going to just focus in on risk capital. Some of you might see this at work. Guys, we know a lot about the risk regulations all around us, whether it might be the Basel regulations. As we stand here today, there's a lot of talk about the Basel III and changes coming in. But for every risk that we take, and we often define this in terms of risk-weighted assets, guys, the risky assets that you hold. For every risky asset, guys, the idea of having some requirement to keep some risk capital. And what we're going to see here in this area here, these risk-to-return ratios, it is often in a portfolio context. You've got the risk-adjusted return. Guys, something like where you've got return on the top and you've got risk on the bottom. So in our CFA program, you've seen lots of things like the Sharpe ratio, the trainer measured information ratio. We're going to look at some of these ideas as well. Here, though, it's more from a high level area here, where you might have risk-adjusted return on capital, where, guys, you've got the return over the capital you're having to set aside for losses. So, guys, that capital you're setting aside, what are you actually earning from it? What are all the costs involved in the risk management too, in operating this business? Or are you going to pull out of that area as a whole and, guys, optimize your risk capital in some new area? So this is quite a kind of current area that our syllabus covers really, is the idea of what return are you getting on your risk capital. We're going to look at that in more detail here. So like we said, the top-down approach is all about the risk appetite. What markets, what instruments, how much risk do we want to take? defining derivatives, defining short positions, long positions. Perhaps there are VaR limits going in here, and then talk about some of these types of limits that might be used. The idea of risk budgeting sometimes might be called downstreaming, where you take a firm-wide level of risk and it flows down to different departments in your organisation. So having a risk budget, for example, VaR would be a dollar limit, okay, or a yen limit. Guys, it's a monetary limit in this way. Guys, stop outs, trying to reduce your losses, stop losses in this way. Or maybe you have certain types of limits like leverage. I mentioned Basel III just now, applying to the banking area. From 2018, just out of interest, 33 to 1, guys, is going to be the leverage limit under the new banking ratios. Certain banks, certain key strategic banks, it's going to be higher than that. So, guys, there's a lot of look in this chapter about ways perhaps to prevent losses becoming too high in the first place. Guys, the kind of preventative measures to manage our appetite for risk. Maybe it's a credit rating. We're not allowed to invest in certain lower quality grades. Maybe you're not allowed to invest in commodities, not allowed to invest in hedge funds. Guys, establish your appetite for risk. Now, all the way through, we've been talking quite a lot about what the expected, like the average or mean, expected rainfall, expected snow, guys, expected losses. We've talked about the unexpected, which is the extreme. Those low frequency, high impact events that could really hit us. Just out of interest here, in the weather example here, and some of you are in the very snowy climes. Those of you, perhaps if you're in Russia, for example, where you have loads and loads of very cold temperatures all the time, often you'll have high frequency, high impact events. Because they happen all the time, you get quite good at handling them. Often, I know in London, when we have the smallest amount of snow, everything's chaos because we're not used to it. We're not geared up for that kind of thing. So these kind of events that really hit us, and the catastrophic losses, guys, these catastrophic losses we've talked about, our stress testing, our scenario analysis, just the what if the market is worse than we thought. Yeah, the kind of what if analysis here. Just what if it's worse than we think. So that's what they mean, guys, by running scenarios, our stress testing. Here, our VaR limit, trading desk may not exceed 25 million. In London, we had a famous case with JP Morgan, guys, called the London Whale, where the VaR was estimated to be 70 million, and guys, the losses that ensued were in the billions. So guys, we know that VaR itself is not a maximum number, and stress testing, scenario analysis is very important. There's our leverage limits. Just out of interest, a famous time in risk, 98, with long-term capital management, heavily leveraged. Remember, guys, small changes in your portfolio, if the risk factors go against you, in their case, credit spread starts to widen, heavy leverage, guys, it wasn't long before losses followed very quickly. Now, liquidity as well. In our area of risk, we've mentioned quite a bit on credit risk, market risk, operational risk as well. You could argue perhaps the missing risk until the crisis was our liquidity risk. And it's not mentioned too much in this chapter here, mentioned here. Two new ratios, guys, in real life coming in. Liquidity coverage ratio, net stable funding ratio. Level 3 isn't going to ask you about those, but guys, just the idea of market liquidity risk, asset liquidity risk. What they do cover in quite a bit of detail, like we mentioned in another area, is the idea of the bid-ask spread. Remember, the effective spread is the measure of your liquidity that you've paid. Lower the spread, Guys, the narrower the bid-ask spread, the less the costs. Wider the spread, the more the cost of trading in and out. So let's have some exposure limits, perhaps not allowing certain types of lower quality perhaps, or having a maximum there. Maybe the way we trade, perhaps we're restricting short positions perhaps too. Now remember, over the counter, we are talking a lot about counterparty risk. The things like collateral and netting are in play, hedging as well. Remember the scenario here over the counter is normally we've got a bilateral agreement, netting agreements. Guys, ISDA, International Swaps and Derivatives Association Master Agreements, Credit Support Annex detailing all the conditions about the trade, like these things here. And how it's going to work normally is mark to market. We're going to revalue the trade every day, maybe have an agent acting on our behalf. If we're winning on a trade, we're going to require collateral delivered to us. Guys, the guys that are losing on the trade, our counterparties, they are losing on the trade, have to post collateral to us. Guys, we want a haircut the excess collateral higher value than we require. Often have a threshold. Not all of our value is collateralized, only above the threshold, because we're going to ask for collateral above the threshold in this way. Netting, like we've talked about, guys, payment netting reduces the congestion, reduces the payments as well too. And one other one on here, not on here, hedging. Guys, hedging too. So in defining our exposure, we often talk about our expected exposure. It is going to be net of collateral, netting and hedging. And that's the residual or remaining exposure. So guys, yeah, other ways to protect ourselves, perhaps by buying insurance. Now, guys, let's just check in here with fixed income, a few reminders here. Remember, for example, a credit default swap. Guys, covered in fixed income as well, credit insurance, also a credit put, guys, covered in there in that area as well, covering yourself against a drop. Also, guys, in here, a credit spread option. Yeah, credit spread option, where you have perhaps a strike spread and a realized spread. Say the strike spread is 2%, and you cover yourself if the spreads widen, perhaps they widen to 3%. Guys, you're going to get a payoff times a notional principal times some sort of a multiplier in this way. So remember, in the fixed income readings, credit derivatives could be used to protect yourself, guys, against this. Credit forward contract or credit options, they're all in that reading, aren't they, there too? What they all have in common, though, is you still over the counter and you still have counterparty risk. Remember, guys, your counterparty risk, they may not pay you. In real life, we call that wrong way risk or double default risk. They may not pay you just when you need them to pay you, like AIG, for example. Now, when we talk about trading, maybe you set up a separately capitalized company through a special purpose vehicle. Guys, they mention here the Enhanced Derivatives Product Company. To give it perhaps a stronger credit rating. If this is stronger than yours, then it's going to keep your kind of trading costs lower in this way. That's why perhaps non-AAA may find it more effective to set up a separately capitalized firm to keep their borrowing costs lower. The risk appetite for the firm, the idea of downstreaming this, the idea of allocating these guys across the firm in this way. Just a quick mention of some very topical guys areas here. We've talked about credit risk, talked about market risk, operational risk, liquidity risk, other risks as well. What are we assuming, guys, as far as the correlation goes? Remember, enterprise-wide risk management, at some level, you're going to think about aggregation. And there's lots of ideas about this, but one thing mentioned, guys, here is you've got the normal markets, versus more crisis markets, when of course correlations can really change. So important, guys, to consider the correlation aspect. Not easy to aggregate VARs together either there. In the regulators, the Basel regulations, they assume a silo approach where you purely add them all together. I also teach Kaya. They have a little interesting little thing here. Just to quickly blink into this, they say that in a crisis, the risks can kind of sometimes melt together to be higher than the sum of the total. A bit like kind of Chernobyl disaster, when the kind of impact of that, perhaps someone making a human error, as with that Chernobyl disaster, it was human error that turned off the safety protocols, made a mistake. Guys, the resulting impact of this combined risk was absolutely disastrous. So what they're saying, guys, here is the correlations. It could be a combination of events that could actually make risk even higher than the total sum together. All our CFA text is, guys, saying here is be very careful. Normally, it would be less than the sum added together due to diversification, but occasionally there could be market conditions that make risk even higher. Yeah, VAR limits, really, the correlations are important. You can't just add them together. So we've got a few famous risk ratios here. Some guys you've seen before. Just going to mention these two. Lots of times in level 3, the Sharpe ratio will be quite handy, and a few times got to be quite wary of it. Where I'd say it's pretty useful to you is in the asset allocation area. Some questions require you to choose between perhaps 5 portfolios. Recommend, perhaps you've ruled out some in terms of risk or in terms of return, ruled out some in terms of liquidity or non-qualifying asset classes. Perhaps you're left with 2 or 3, and they do give you a risk-free rate. Guys, pick the one with the highest risk-adjusted return. Because one unit of risk, which one has the highest return for that unit of risk? If they don't give you a Sharpe ratio, guys, remember we can take away the risk-free here and perhaps have a minimum target return, have the target return as 0. Remember we call that Roy's Safety First. Roy's Safety First just has a target return, perhaps have that as 0. So you could use that as well. Also, guys, we've got the Sortino ratio mentioned here as well. And again, a bit like our Roy's Safety First, here you've got a minimum acceptable return. Yeah, a minimum rate of return, not the risk-free, of course. And here we're looking at downside deviation. It's more like it could be the semi-standard deviation or target semi-standard deviation. Remember, guys, where you're looking at returns purely below the mean or below some sort of target here. And you'd normally be given that in a question. One little health warning with the Sharpe ratio, though, is anything to do with the alts chapter. So, guys, why? Why is it a problem using the Sharpe ratio with the alts chapter? Well, the problem is that most of the alts areas don't follow a normal distribution. They're skewed, like negative skew, or leptokurtic, whereas this here, the risk here in the Sharpe ratio, assumes it's normal. Okay, so straight away, just to watch out for the comments about the Sharpe ratio, as you've got here too. We talked about capital quite a bit in our kind of model of this. As we stand here today, 2015, the amount of risk regulation is very high. Guys, we talked about return, we talked about risk as well. And that's all this measure's trying to say here. I'll give you an example of this here in the UK that's been happening. Say you wanted to get financial advice on a pension, guys. Maybe like me, you're younger than I am. I'm thinking about pensions at the moment, perhaps in the future here. And if I wanted to get pension advice, on the high street, on Main Street, then it'd be quite difficult to do that in the UK right now, because a lot of the bank and providers, investment providers, have pulled out. They've said, well, you know what? it's too expensive to provide these advice structures, supervision, suitability, the paperwork, guys, the training, the examinations. Instead, what we'll do is we'll provide information only. So it's ironic, really, that the amount of regulation the regulators brought in has actually taken away access to advice. So guys, banks are looking at the amount of capital you've got to put aside, the amount of costs of risk management, amount of red tape as well. And this type of ratio here, is your return high enough? Or are you looking perhaps over here at other business areas that earn the returns without much capital? So guys, they're looking at optimizing. Could that capital be better used elsewhere in this way? So guys, risk-adjusted return on capital, the idea of looking at the returns compared to the risk capital. In the hedge fund world, yeah, the Sharpe ratios, return portfolio minus risk-free over our portfolio risk, they might look pretty good. Why do they look really good? Because, of course, a lot of the strategies are negatively skewed, and this type of risk is masked. Just because the losses haven't happened yet doesn't mean they won't happen. So quite popular, guys, in the hedge fund area, the idea of drawdowns. Remember, guys, a drawdown is from a high to a low value. You might look at a daily drawdown. Guys, over the last day, what's been the drop in the portfolio over the last week or month as well? So again, you've got return over a different definition of risk. Guys, yeah, so for 1 unit of drawdown, what return have you brought home? Remember, if you are comparing funds or comparing time periods, you've got to have a similar time period in your drawdown, daily, monthly, weekly. But the maximum drawdown, the largest decline from a high to a low over a particular period. Like we talked about, guys, just now, we've talked quite a lot about the actual risk techniques. Where we're going to finish off here is talk capital. So we're kind of talking regulators that are coming in here, and here's where we come back to our loss definitions at the very end. Now, expected losses, no capital set aside. The thinking behind this is that expected losses should be built into your pricing model. Guys, if you're a lender, then you're going to get some losses, build it into your model. Catastrophic losses, no capital. Guys, you wouldn't be able to have enough capital to cover the worst case losses. Guys, those that are really in the tail, 99.9999, these are really extreme losses that only happen very, very infrequently. Guys, it wouldn't be possible to have that much capital. So we only set aside capital, guys, for unexpected losses, which we talked about, often defined using a VaR measure. Again, you're not going to be needed to know this, but VaR is very popular with the regulators, and they do actually set 99%, 99.9, 99.9 for these two. So what the regulators will do is set the capital based upon, guys, a definition of VaR. They actually talk about 10 days to market risk, 1 year holding period for credit risk and for operational risk as well. And that's what they mean, guys, by VaR being used to set these requirements. And just to illustrate how inaccurate a VaR really is, because we know losses can be far higher, the regulators know this too. So the regulators have VaR. They also have a stressed version of VaR too, using more stressed historic data. And these are added together. So normal conditions, non-normal added together, guys, just shows you, how cautious we are. And then they also use some kind of a multiplier as well, normally between 3 and 4 times. whatever estimate of VAR you have, they tend to multiply even higher. So guys, it just shows you how much we realized that the modeling of the losses, guys, really didn't help us too much with the real crisis. So in our text, none of that's kind of reflected, just the idea that capital there can be modeled with VAR. The recent trend, guys, with Basel III, though, of course, is to up the capital quite massively. That's going to happen all the way to 2019. So guys, stress testing, we've talked quite a bit about VAR only covering to your confidence level. Here's a 95 one. What about beyond our VAR? Remember, tail VAR was covered, guys, in the third in our VAR area. Tail value at risk is the average. Remember, guys, that's the average loss beyond the VAR. Stress testing also. Remember, guys, again, from that earlier reading too, you've got stress testing and scenario analysis as well. 3 models for each as well there too. And do we carry on with that level of risk, or do we reduce the risk?